Hi guys, this is Dan from the Investment ABC, and in this video I want to discuss if the bears are wrong and if another long-term bull market really has started, or if this rally is a giant bull trap after all. My subscribers know that I bought aggressively into the stock market when the Dow was sub 19,000 because the markets were full on in panic and capitulating. But on the other hand, I did not expect the markets to recover that much. I was expecting the Dow to continue its decline when hitting the 25 to $26,000 range. So I sold my stocks and bought a put option which was stopped out with a small loss. I went against my own investing principles, which is that in the markets nothing is really impossible and that you should be positioned for all outcomes. Making mistakes and learning from them is the key here. Am I still bearish on the stock markets? Yes, I am, and I think the current rally is a giant bull trap, but markets can stay irrational longer than most of us can think is even possible. Evidence for this is that even bankrupt companies like Hertz can 10x in just a few days, while an experienced investor like Carl Icahn sold his shares at a low around 72 cents just to see the price rebound back to over $6 in a couple of days. Another good example for exuberance is Boeing, which doubled its market cap in just 1 month. What I learned about markets in all these years is that long-term bull markets end when the masses jump into the markets to get rich quick. Many millennials and retail investors saw the coronavirus as a big opportunity and jumped into the markets thinking that stocks are cheap now. Most of the times, these new and inexperienced investors have no clue about valuation metrics or even what a market cap is. They just saw the prices plummeting and started to buy without thinking about the earnings decline. The whole stock market reminds me of the 2017 cryptomania when retail investors bought Ripple, for example, because it was just trading for a few cents compared to Bitcoin, which was trading for 15,000 US dollars. They did not understand the concept of market cap, and exactly that is what is happening currently in the stock market. The surge in retail investors could be observed by the increase in new Robinhood accounts and an increase of Google searches for words like call options and day trading. While experienced investors like Buffett, Druckenmiller, or Carl Icahn are fearful, the retail investors are getting more and more greedy. We will see who will be right in the end. To understand why a continuation of the decline could happen at any moment, we have to know the driving forces of this current rally. We already said that retail participation is a big factor for this push higher. This is due to the stimulus programs, in my opinion. Many unemployed don't want to work anymore because they make more money by doing nothing. Obviously, when you have more money at hand, you either spend it or invest it in the markets. Furthermore, many people don't need to pay rents or mortgages for a while without seeing any repercussions. I wouldn't be surprised some people taking the rent or mortgage money and putting it into the stock market. But the most important driving force for this rally, in my opinion, is the Fed openly admitting that they are flooding the markets with liquidity and having the markets back. Everyone knows the saying, don't fight the Fed, and hedge funds were the first who were jumping into the market when the Fed put started. This changed the sentiment and psychology of the market from fearful to nothing can stop this market anymore. The markets are driven by greed and fear, and the Fed pulled the trigger from fear to greed. By buying corporate bonds for the first time ever, the Fed is providing enough liquidity for all the companies that wouldn't have survived because of their already high debt levels. So when bankruptcies are prevented, it is good for the stock market. That is what investors believe. Many are also afraid that this unprecedented expansion of the Fed's balance sheet will lead to very high inflation. So everyone with a lot of money is afraid of losing purchasing power, so they flock into real assets no matter how high the valuation is. It is basically a fear trade and similar to people buying gold and silver at extremely high premiums. Another factor which is driving rich investors into tangible assets is the fact that the Fed lowered the reserve requirement ratio to 0 for banks. Prior, they had to hold between 3 to 10% of the depositors' money as reserves in case people would demand the money back. But banks now have the ability to lend out all the depositors' money or gamble with it in the stock market, making the banking system even more fragile while driving up asset prices. Furthermore, the media is spreading the narrative of a V-shaped recovery of the economy and that jobs will quickly come back when the economy reopens. Investors were believing this narrative and pushed beaten down stocks like cruise lines, hotels, and airline stocks higher. I was wrong by expecting the market to sell the news once the economy starts to reopen immediately. But it might still happen when it is clear that the jobs won't come that quickly back as many economists believe. Now that we know what was driving this huge rally of the lows, we can assess whether this rally is the start of a new bull market or a giant bear market rally. In my opinion, it is the latter one, because new bull markets don't start in euphoria, they normally end in euphoria. New bull markets start when stocks are hated for a long period of time and slowly grind higher during accumulation periods. To me, it looks like a giant pump and dump by the Fed and Donald Trump, who desperately pushes the narrative that a rocketing stock market means also a rocketing economy. We have to ask ourselves which of these driving forces will fall away first. Is it the stimulus checks? In my opinion, this is the most likely one because the economy is reopening again and companies need to hire people again at least a little bit. But if the unemployment benefits are so high, it will be hard for the companies to compete with this kind of unemployment payment. On the 31st of July, the $600 per week additional unemployment payment from the federal government is about to expire. This would put significant pressure on a lot of people and reduce their spending power significantly. It is not 100% clear yet whether the government is extending these additional payments until 2021, but one thing is clear, with almost $1,000 per week, one person can have I would say, decent, comfortable life. Millennials who maybe are still living with their parents or in shared accommodations have enough money to throw into bankrupt stocks with this kind of aid and additional time to watch a couple of Netflix movies a day. If these stimulus payments are gone in July, I think it will lead to also a further decrease in corporate profits and a reduction of small retail investors jumping into the markets. This could lead to a change in sentiment and be the start of a more severe pullback. This pullback could lead to more selling by all those investors who were buying stocks as a protection against inflation once they see that the deflationary forces are getting stronger again. On top of that, all those speculators who bought because of the V-shaped recovery narrative might get disappointed once the unemployment rate stays high for a longer period of time. At the risk of riots and a second wave outbreak, we could have the recipe for a second sharp drop in stock prices, and the V-shaped recovery in stock prices might turn into a W-shaped recovery or even a bolt-shaped one where prices decline under the March lows again. We are now in that stage where most of the bears gave up being bearish and the bulls being more and more complacent. I'm observing more and more bullish comments under YouTube videos from people who are very new in the game, how the bears were wrong and that the market would go up and prices can only skyrocket. Also, more and more pure chartists gave up on the bear market rally idea since the 68.1 retracement mark has been breached to the upside, which is normally a very bullish sign for the markets. The chartists are mostly momentum traders, so they are fueling also the rise in prices currently and buying the dips now. Furthermore, the market is not reacting to any bad news currently, like the riots, the high unemployment, or the surge in cases, which is normally also a bullish sign. The problem I have with the current market, despite these facts, is that on a fundamental basis, the market was overvalued even in March when it hit the lows, although technically it was a screaming rebound back then. Now, after the run-up, the fundamentals look weaker than ever in my opinion. The unemployment is sky high and metrics like the Buffett indicator or PE multiples are at historic all-time highs. On top of that, the bullish sentiment of retail traders are at all-time highs only matched during the dot-com bubble. In my opinion, this bull market was so long because there was hardly any participation of retail investors until the outbreak. Now that retail investors are FOMOing into stocks to take advantage of supposedly cheap prices, a blow-off top is not far away or already occurred. For a sustainable long-term bull market, we need to get rid of over-indebted zombie companies and a reduction of consumer debt. What we currently see is a broad bankruptcy delay which will catch up to us at some point in the future and most likely lead to declining asset prices then. Who knows, maybe I'm completely wrong and we could be in the midst of the last crack-up boom before a massive inflationary tsunami. It is the more unlikely scenario in my opinion because I doubt that all those retail debtors will benefit from a surge in inflation. Inflation will most likely come after real deflation has wiped out those people who are too much in debt. One should try to be prepared for both outcomes, and in my opinion, the best way to do so is a combination of cash, precious metals, and maybe an affordable property to live in. This combination will protect you more than buying stocks at historic high valuations. I'm also looking for undervalued stocks which will do well and grow in the next few years despite what is going on in the economy. They're hard to find, but you can still find them. If you like this video, hit the like button, subscribe and comment to support the channel. Bye guys and see you in the next one.